Right, good day everyone. This is the CICT's latest presentation slides. Right, so it's dated 18 to 19 September 2023. Okay, so this 6 months after the annual report of 2022, which was dated around March to April 2023. Right, so this is a 6 months update from the last video. Right, so net property income increased 10%. Okay, but DPU only increased 1.5%. So yeah, the performance probably not very good. In terms of DPU because of things like interest rates increasing and higher cost of running the business. Okay, not really going to talk so much about this. Outlook, we can talk a little bit. Okay, rental, retail rent and occupancy rent expected to continue increasing positively in second half 2023. We'll see later that this one has improved over the annual report because it's a very clear-cut rental revision in a positive direction. Right, so because of the main drivers are limited new supply and increasing tourist arrival. Right, office also improved, right, but I think the outlook is not so optimistic because of low economic growth and tapering demand. Right, so the latest step, these two we've not seen yet. Alright, so you can see the leverage gone down slightly. I think they paid off some of their debt. Right, and then we look at interest coverage ratio dropping, which is not good. Right, this is how much times you can pay off your interest. Right, so this value dropping is not a good thing. And cost of debt increased by 0.1%, again not a good thing. Alright, we'll compare this with these numbers, which is from the 2022 report we looked at the last video. Right, so you can see the trend is not in a positive direction. Alright, the interest coverage ratio used to be 4.1, it dropped to 3.7, and then it dropped to 3.4 and then 3.3. Right, and cost of debt has gone up from 2.3 to 2.7, to 3.1 and 3.2. Yeah, so not the best thing, but I think most REITs have the same problem. So you can see 2023 they sort of cleared the debt revisions. They clear a little bit of 2024. Alright, so moving on to the retail performance, which is the good part. Right, so rental revisions is up 6.9%, and you can have a look at the breakdown between suburban and downtown malls. Alright, downtown malls has recovered at least of this latest report. Alright, you can see the overall rental revision is up 6.9%. Right, so this is the latest report. We contrast this with one. This is from the annual report that we discussed in last round. You can see there's an added column here to try and justify why the downtown malls actually dropped by 3.5%. But they say, oh, overall, over 3 years, it actually increased by 0.2%. So the last rental revision as of March this year, 2023, the report showed quite bad in downtown still. Right, and that has since recovered. Now you see the downtown is up 7%. Right, so it's a very clear swing to the positive direction, which is clearly a good sign lah, which means the CBD areas, downtown malls has turned a corner, right? At least numerically. Right, so tenant sales has gone up, especially downtown mall. You can see improved by 10% per square feet, which is great. Suburban mall, not too much of a change. Right, shopper traffic, you can see downtown mall a lot larger now. Right, mainly due to tourism recovery and increase in office crowds returning to office. Right. Yeah, interesting to note that food and beverage, fashion, beauty and health, supermarket and home furnishing are the biggest trade categories. Alright, so anyway, go to office. We can see that for office, general rental revision is up 9.6%, which is quite impressive. Alright, they are saying that their grade A offices are due for an revision outwards because the average grade A office rent is 1180 and most of them are below 1180. Right, so this one is above lah, but the rest are below 1180 lah. This one is also above. Right, so other than this one and this one, which is 6 Battery Road, the rest are actually below the average rate. Alright, I won't look at too much except the Singapore market. Alright, limited retail supply from 2023 to 2025. Alright, and mostly in the fringe area, which means the downtown area is still dominated by CICT. Okay, office, no new CBD. beyond no new office in CBD beyond 2023, right? So the demand comes from tourism and F&B. And for office, private wealth, I think this has been a big trend in Singapore, that more and more rich families are coming here to set up shop, right? Asset management, law firms, professional services, and government agencies. Yeah. So hopefully the real drivers are private wealth lah, so that can charge them more expensive office rents, I guess. Right. So the outlook for office isn't so great in the second half of this year though, right? Not so worried about Australia and Germany, right? They're saying that retail supply is mainly outside central region and fringe areas, right? So downtown areas is more or less still CICT, right? So tourism recovery, these are the main drivers for improving numbers in the future, and they expect the full recovery by 2024. So hopefully it will help with better rentals as well, right? This is just the office stock, right? This is interesting because the grade A office rents, right, you can see that for a long time from 2011 to 2023 sort of stayed flat, right, per square feet, which I'm a little bit surprised, right, because you can see that it keeps dipping, right, and you see the highest point is something like $18.80 in third quarter 08, just before the global crisis, right? So there's quite a lot of room for this to move up, I think, given the fact that it stayed flat over the years, right? So hopefully the grade A office rents can show better improvements in the longer run. Right, with that, that'll end the sharing for today. Please note that it's not a call to buy or sell, and this does not constitute any financial advice. Okay, thank you.